Chapter 12, Some Lessons from Capital Market History. In Chapter 12, we will look at the historical relationship between risk and return. Historical refers to the idea that we are looking at the actual data from the past. So we know what has happened to, let's say, stocks of different companies, and we analyze the data that is available to us from these two perspectives, risk and return. So we will look at return. What is return? How do we calculate return on an investment? And then we will look at historical returns on various types of investments. Then we will look at risk. What is risk? How do we calculate risk on an investment? And again, historical risks on various types of investments. And the last big topic in this chapter will be on why stock prices change all the time. So we finished chapter 10. In chapter 10, we were focusing on how we calculate estimated future cash flows from investment. If you're wondering what the link is between chapter 10 and chapter 12, well, in chapters 12, 13, and 14, we will focus on the discount rate, right? The rate of return on an investment. Okay, so 12, 13, and 14 have this, discount rate in common as, being the main topic. In chapter 12, we are looking at looking back at the past several decades. What has been earned from different investments, and we, look at the differences. And then in chapters 13 and 14, we will look at sort of how to then apply that knowledge to estimating future return on investment, which is also nothing but the discount rate for, let's say, some project. So let's start with the topic of return. We've been using capital letter R to denote return on an investment. Actually, maybe some of you have been, Googling for some topics to, kind of clarify in your head what certain topics are. Or maybe you've been watching some YouTube videos, whether they're mine or not mine. Maybe you have noticed that depending on the textbook, a different notation may be used for return. So it could be not just capital R, it could be lowercase r, which stands for return. It could be lowercase I, which is also very common. I stands for investment or interest rate, actually. So, it's not always capital R like in our textbook. It could be other notations, but lowercase r, capital case R, and lowercase I are sort of the most commonly used notations to indicate the return on an investment. So in our book, it's R, capital, and we've actually been giving it a lot of different names. You may have realized that we are using different names for the same thing. Discount rate, interest rate, APR, which stands for annual percentage rate. We have this in chapter 6, where we were first looking at nominal versus effective annual rate. Then yield or yield to maturity. This is used for bonds. And we have this term in chapter 7. Rate of return on an investment. So all of these are used kind of interchangeably, and they all indicate the return on some investment. So what do you mean by return on an investment? In this example, in year 0, you invest $100. In year 1, the investment returns $105, right? So how would you calculate the dollar return on this investment? Well, in dollars, you get $5 richer, right? Which is calculated by taking the ending value, 105, and subtracting the beginning value, 100. 105 minus 100 equals $5. But more commonly, the return on investment is calculated in percentage terms. So to calculate the percentage return on investment, we want to take these $5, the return in dollars, and kind of look at it from the point of view of relative to how much we started with, how much richer we got in percentage terms. So we take 5% dollar return and divide it by the initial value or the starting value, how much was invested, right? So 5 divided by 100 equals 0.05 in decimals or 5%. So the return on this investment is $5 or 5%, right? It's 5% of $100 that were invested. Both ways are correct, but typically by return we mean some percentage. The second example, in year 0, the initial investment is $300. In 1 year, this investment returns $360. What's the return on this investment? Well, the dollar return on this investment is 360 minus 300 equals $60. The percentage return on this investment is $60 divided by $300, which is how much we invested. So relative to how much we started with, we got 20% richer, right? The return on our investment was 20%. So 60 over 300 gave 0.2 in decimals, which is the same thing as 20%. In this chapter, we will be primarily talking about returns that companies offer on the stocks and bonds that they sell to investors as a way to raise money, right? Since we are studying corporate finance, this is the appropriate financial investments to focus on, stocks and bonds. Let's look at another example related to figuring out the return on investment. Let's say we are looking at the return on some company's stock. Today you buy a share for $500. Next year, 2 things happen. You receive a $10 dividend from the firm and the shares appreciate to $550, right? So you can sell each share for more money, $50 more. In other words, at any point of time t, you pay some price, which we denote by capital P subscript t, lowercase t. So in this example, it's $500, right? Then at time t plus 1, which basically means 1 time period later, and in our context that's in 1 year, 2 things happen. First, the new price per share is denoted by capital P subscript lowercase t plus 1, and in our example that's $550. The second thing that you can also receive, right, if you sell your share, so if you sell your share, you got $550 for it, but that's not the only source of income for you over the year, because on top of that you also received a $10 dividend. The notation for dividend, as always, is capital letter D, and the subscript to indicate time t plus 1 is t plus 1. So altogether, if you sell your share after 1 year, the total cash received will be $560, which is the sum of the $550 new price at year end and the $10 dividend paid at year end. The dollar return in this example over 1 year is $10 coming from the dividend received plus the difference between the stock price before and after, 550 minus 500. So we get a total of $60. The percentage return over 1 year is those $60 divided by $500 which were invested at the beginning of the year. This equals 0.12 in decimals, which is the same thing as a 12% return on the investment over 1 year. And this slide may look familiar. It already came up in chapter 8, in which we were focusing on stocks and how to calculate the stock price today, as well as how to decompose the annual return on stock investment into the two components that we are also seeing here, the dividend component and the price change component. So in this example, the income that comes from the dividend paid to you is called the dividend income, which is $10. That's capital D subscript T plus 1. The dividend yield is the same thing except expressed in percent. Percent relative to how much was invested at the beginning of the year. So we take $10, divide by $500 and get 2%. That's D T plus 1 divided by P subscript T. So 2% is interpreted as the return on your investment coming just from the dividend paid to you, right? So the dividend paid to you is an extra income to you. And relative to how much you spend to buy the shares of stock, that's a 2% financial gain. But that's not the only way for you to get richer over the year in this particular example. In this particular example, you also have what is called capital gain. That's a $50 increase in stock price. So 550, the new price, minus 500, the original price, equals $50. The ending price minus the beginning price. P subscript T plus 1 minus P subscript T. In percent, you take those $50 and divide them by $500 and get a 10% return. This is known as the capital gains yield. So you take the ending price, subtract the beginning price, and then this difference is divided by the beginning price. Or, like I often explain to my students, new minus old divided by old. If you combine the two sources of your financial gain, the dividend income and the capital gain, you get the total dollar return. So that's $10 plus additional $50 equals $60. In percentage terms, the dividend yield, 2%, plus the capital gains yield, 10%, gives the total percentage return of 12%. And the total percentage return is also the same thing as the total dollar return, $60, divided, as always, by $500 invested at the beginning of the year. So in a way, there are two ways to calculate the total percentage return. The total dollar return divided by the original price paid, or you separately calculate the dividend yield, then the capital gains yield, and then add the two percentages up. To summarize, the total dollar return is the sum of the dividend income and the capital gain. There's also a term known as capital loss. That's when the new price is lower than the old price. So for example, you buy stock for $500 today and next year the price drops, so you lost money. Technically, finance people often call everything capital gain. If there is a loss of money, then the capital gain is a negative number. So a negative capital gain is the same thing as a capital loss. In percentage terms, the total percentage return is the sum of the dividend yield and the capital gains yield. The dividend yield, by definition, is the dividend over the next year divided by the price per share paid today. The capital gains yield, by definition, is the change in price from the beginning to the end of the year divided by the price paid to buy shares of stock at the beginning of the year. And technically, these two yields are coming from this mathematical, trick in which one fraction can be split into the sum of two fractions. So the one fraction I'm talking about is, the sort of the original method of calculating the total percentage return, where you take everything you receive over 1 year, which is the dividend in year t plus 1, and the new price per share, price t plus 1, and you subtract what you paid at the beginning of the year, which is price subscript t, and then you divide that total dollar return, which is essentially what this is, by the price paid at the beginning of the year. So this is how we calculate the total percentage return, which is denoted by capital R. And again, the last few slides should look very familiar because we had exactly that like in the second part of chapter 8 on stocks. Historical stock and bond prices. So let's look at the next 5 slides. Financial markets. What do you mean by financial markets and why are they important? Financial market is not necessarily a physical location where something is traded. It's something more general than that. So all the different ways that equity securities, also known as stocks, and debt securities, also known as bonds, both issued by companies, right, are bought and sold. So who sells them? Companies. Also, governments can sell debt securities or bonds. Who buys stocks and bonds? Anybody you can think of. Investors, people like us, other companies, other governments, investors and governments and companies in other countries, and so on. Also, you can say that financial markets is a way of bringing buyers and sellers of these financial assets together. The existence of financial markets, the existence of this possibility to buy and sell stocks and bonds, allows companies, governments, and individuals to, as we say in finance or economics, to increase their utility. What does it mean? So we have savers and borrowers. Savers are those who have extra money. Borrowers are those who need money. So savers are, for example, people like us who have extra cash and we are willing to invest it into bonds and stocks. So savers have the ability to use the financial markets to invest in financial assets, stocks and bonds, so that they can defer consumption, right? Because they have extra money now that they don't really need. So they sort of put it aside, invest, wait a while, earn a return on it, and this is in a way a compensation for postponing spending the money, right? So they're allowing the money to be used by somebody else. They wait maybe several years, and then they get the money back and they're compensated with a return paid in the form of, let's say, dividends if that was stocks, or coupon payments if that was bonds. On the other side, we have borrowers, those who need money. And in this chapter, we are talking about companies that need money, for example, to expand. So how do companies raise money? They can sell bonds. Technically, by borrowers, we also mean raising money by selling stocks. So stock is, it's not really debt to a firm, but it has, those kind of features that debt securities or bonds have. And that's kind of how we are looking at stocks in this chapter. So firms that need money, they can sell bonds as well as stocks. And they do that because they have access to this capital through the financial markets. So there are a lot of trading platforms, well organized, that allow firms to raise money through these two different sources. selling stocks and selling bonds. And the reason firms, raise money is so that they can invest the raised money into assets, maybe, their expansion projects, whatever that might be, that would generate profits. So it's a win-win situation. Savers, they, people like us, for example, they invest money that we don't really need at the moment into stocks and bonds, and we earn return, from the company, right? And the companies, they get the money from us, and the way they benefit is they invest our money into their projects that also bring them, returns. So of course there is risk involved in this process. Savers cannot be sure 100% that they will get their returns, such as dividends or coupon payments, as well as borrowers, the companies that raise money. They cannot be 100% sure that all those projects that the money will be invested into will be profitable. So it's kind of like, this a risky, process for both, sides of the financial markets. But we won't focus too much on this sort of very general big picture. So let's zoom in. Let's look at historical stock and bond prices. What do we see on this picture? This is figure 12.4 in our textbook. This is a $1 investment in different types of portfolios between December 31st, 1925 and December 31st, 2016. What's going on here? On the horizontal axis, you see a timeline. It starts in the year 1925 and ends in the year 2016. Then along the vertical axis, we have dollar amounts. Everything in 1925 starts with $1. So imagine you had, a great-great-grandfather, and he had a few friends, and they all decided to invest the same amount of money, but into different things. Let's say your great-great-grandfather invested $1 into small company stocks. So this is the green line on this figure. What are small company stocks? They're also known as small cap stocks. This is a portfolio. So the term for portfolio, it will actually come up in chapter 13, our next chapter. But it means you're not buying just one company stocks, but you're buying stocks from several different companies. And small companies or small cap stocks means you're buying stocks of the smallest 20% of the companies whose stocks are traded on the New York Stock Exchange. So that's what the first investor invested his $1 into. Then the second person instead invested his $1 into large company stocks. Large company stocks is a portfolio of stocks of 500 largest companies in the United States. So you can think of these small cap stocks and the large company stocks being on the opposite ends of the spectrum of stocks you could be buying by company size. Then the third person also invested $1 in 1925, but he invested his money into long-term government bonds, the blue line. Long-term means bonds that pay coupon payments over a long time period. So think of 20 years to maturity. And then the fourth person in 1925 also invested $1, but his money was invested into treasury bills. Treasury bills or T-bills are also government bonds, but very short-term government bonds. They pay coupons over just a few months. So think of 3 months to maturity. And you can ignore one extra line that this graph has called inflation. We are not gonna be talking about it. So focus on these four lines: small cap stocks, large company stocks, long-term and government bonds, and treasury bills. Let's start with the following. What differences can you notice between the investments? So how about I rephrase this question? If you were that person who invested $1 in 1925, and let's say you lived until now, right, 2016, which investment was the best one? Like, what would have been the smartest investment to invest $1 into? And you're probably thinking, well, the small company stocks, the line that's the highest up on this figure, right? And you're probably saying that because in 2016, that $1 grew to $33,214.15. That's way above the ending values of the other three investments. For the large company stocks, that's only $6,029.16. For long-term government bonds, it's much smaller, only $133.19. And for the treasury bills, the short-term government bonds, it's only $20.62. If this is how you are determining which investment has been the best, then you're basically talking about the trend, like which line has reached the highest point, right? In other words, which line has been sort of the steepest, going up at the fastest rate. That's the trend. And it's true that the small company stocks have increased in price the most. In other words, they brought the highest return over this 91-year time period between 1925 and 2016. But there's a different way to look at this graph. If the question is which investment has been the best. And this is from the point of view of, how jumpy the lines are, right? How much the investment value was fluctuating along the way. So if you look at those jumps, which means in some years your investment is worth a lot of money, next year you lose a lot of money, right? In terms of the jumps, which line jumps the most? It's the small company stock, which is also the one with the steepest trend, right? So small company stocks have been jumping up and down the most, which makes the small company stock investment the riskiest. And now you may notice this trade-off between the risk and the return on an investment. So the small company stocks have generated the highest return, but this investment has also been the riskiest. The large company stocks have also produced a very good return, second highest, and they're not fluctuating as much. They still go up and down quite a bit, but not nearly as much as the small company stocks, and so on. So the risk and return, they kind of go together across these four historical investments. So to summarize, small company stocks had the highest average annual return. Then go the large company stocks. Then go the long-term government bonds, and then at the bottom are the treasury bills. The textbook also, kind of here and there inserts short-term government bonds, which fit between the long-term bonds and the very short-term 3-month treasury bills. So now let's see how would we calculate the historical average annual return. Let's denote the return with capital R And to indicate that that's the average return, let's put a bar above it. So our bar is the average annual return. What do we mean by return? Let's say, so this graph technically doesn't show returns in percentages. It shows dollars, right? If you look again at what's on the vertical axis, we don't have percentages, we have dollars. So maybe in year 1996, the value of the investment was maybe $2,000. And maybe in 1997, the value of the investment was, I don't know, let's say $2,700. And so that corresponds to a 33% jump over 1 year. So we can technically take all these dollar amounts for end of each year and convert them into percentage changes from 1 year to the next. So in the year 1996, if you check the textbook, which shows those calculated percentage returns for you, the return for the large company stocks is 23%. For the year 1997, it's 33%, and so on. So you actually have the percentage returns for every single year in this 91-year time period. And then to calculate the historical average annual return, you add all of them up. You can do them in decimals, or you can keep the percentages, and then you divide that sum over by 91, right? How many of them you have. So you get 0.12 or 12%. So 12% is basically given. The book, shows how it's calculated, and this is basically summing up 91 different numbers and dividing the sum by 91. So you don't need to ever calculate it, because this is the historical result. It's already done, it's already known. So 12% is on average every year what the return was for an investor who spent his money on buying stocks of 500 largest companies in the country. Right? So on average, the return on investment into large company stocks has been 12% each year. It's a pretty good return, right? If you do the same math using historical data for all the different investments that we are looking at in this chapter, then for the small company stocks, it will be the highest, 16.6%. Large company stocks, 12%. Then the book also lists long-term corporate bonds, something that hasn't come up yet. So it's kind of randomly popping up here and there, 6.3%. Then long-term government bonds, 6%, and then U.S. Treasury bills, the lowest, 3.4%. So 3.4% is kind of the lowest return you were able to make over the last 9 decades when you were investing your money into financial markets. Let's talk more about the U.S. Treasury bills, the 3.4% sort of lowest return you could earn on your money invested into financial markets. This is known as the risk-free return. Risk-free means that you invest your money and you're absolutely sure that you're guaranteed that you will get your money back with the interest on top, right? So when you buy bonds, the interest you earn is coupon payments, right? Treasury bills are considered to be risk-free because the government can always come up with the necessary money to pay to the investors by, for example, raising taxes. What happens if we subtract this 3.4% from each of, from let's say 16.6% average return every year from small company stocks? So 16.6% minus 3.4%, that gives 13.2%. What does it mean? It means that those investors who decided to invest their money into stocks of small companies, they were 16.6% better off every year on average. They were getting 16.6% better return on average every year. Sorry, 13.2%. They were getting on average 13.2% more money every year relative to sort of the bare minimum return they could have earned if they bought the treasury bills. So 13.2% is the excess return, right? And the benchmark, the reference point, is the treasury bills. It's also called the risk premium. So risk premium is the excess return. It's one and the same thing. The additional return above the treasury bills return. And the reason it's called risk premium is because it's a compensation that investors receive for willingly accepting a riskier investment, right? So that's the return you earn on your investment that you chose minus the risk-free return. The risk-free return is the US Treasury bill return. That's the risk premium. So 16.6% is the return on average earned on small company stocks minus 3.4%, the risk-free return, equals 13.2%. So that's the excess return or the risk premium for buying small company stocks. We can also calculate the risk premium for all other investments in this list. For large company stocks, 12% minus 3.4% risk-free return equals 8.6%. For long-term corporate bonds, 6.3% minus 3.4% equals 2.9%. And the numbers keep getting smaller. For long-term government bonds, 6% historical average return minus historical average risk-free return of 3.4% gives the risk premium of 2.6%. And for the US Treasury bills, the risk premium is 0 because we are, taking 3.4% and subtracting this number. So to summarize, to calculate the R bar, which was the notation we are using to calculate the average annual return for some investment in the past, whether it's a stock or a bond. To calculate the R bar, we need to add up all the R's, all the annual returns, and divide by how many we have added up. This, in finance, is known as the arithmetic average return, right? So the arithmetic average return is what you also mean by calculating the simple return, right? You just add the numbers up and divide by how many you had in your sum, right? So R1 plus R2, and you keep adding the R's, and the last one is R subscript T. And you divide that sum by T. So T is the number of periods over which an investment is made. So in our example with the graph, that would be 91 years. So T would equal 91. In the next few minutes, I would like to cover the topic of calculating the average annual return. We will apply it to stock returns. Say you buy a share of stock today, next year you get extra money. What is your return over 1 year? And we typically calculate it in percent. So let's kind of take a step back and look at the formula that we use. The simple average return, if you wanted to calculate the average return, right? The simple average, as we know from different things we deal with in life, is we take the numbers, add them all up, and divide by how many we have, right? Same idea here, and that's what we call arithmetic average return. So arithmetic average is the same thing as the simple average. If you want to calculate the return R, the average return, R bar, we add the return for year 1, return for year 2, and so on, all the way to the return in the last year we are looking at, which is year T, and divide by how many returns we've just added up, which is T many returns. That's the arithmetic average return formula. Next, let's look at one more way how the average annual return on stock investment could be calculated, and this is known as the geometric average return. So there is the arithmetic average, the simple average, and the geometric average. What is the geometric average return? Let's say this is what we know. Let's say today, year 0, you pay $100 to buy 1 share of stock. So we have stock price in dollars on the vertical axis. And then we have years in the future on the horizontal axis. So today you pay $100 to buy 1 share of stock. 1 year later, the price drops to only $50 a share. Another year goes by, end of year 2, it goes back to $100 a share. Then $200 at the end of year 3, and $150 at the end of year 4. This is what we are given. Let's answer the following 3 questions. First, what is the return you made if you bought this share of stock over the next 4 years? Second question, let's calculate the arithmetic average annual return over this 4-year time period. And 3, the third question is, what is the geometric average annual return? Let's start with question number 1. Return over the 4-year period. For that, we need to first think of what the investment was worth at the beginning of the 4-year period. So how much did you pay to buy it? $100. It's given, right? Next, what's the ending value of your investment, which is end of year 4? That's also given, $150 at the end of year 4. What is the dollar return on this investment? Well, how much extra money did you make? You made additional $50, right? Which is the difference between what you have at the end and where you started. What's the percentage return? Well, we take the $50 additional money and divide by our starting point, which is $100 at the beginning. And we get $50 extra money earned divided by $100, the original amount invested, and we get a 50% return, right? So that's over the 4-year time period, a 50% gain, a 50% return on your money. So the point of this question was to show to you that we can calculate the return over 1 year or 4 years or 100 years. It doesn't matter. But usually what we do in finance, what we are interested in finance, in the textbook, in real life, is how much you earn on the per year basis. And that takes us to questions 2 and 3. 2 being, what's the average return over 1 year? And we want to calculate the arithmetic average. And in question number 3 that we will do later, we will instead look at the geometric average and what's different about it. So to answer question 2, what is it that we need to calculate? Arithmetic average annual return. Return is typically calculated in percent, right? Like 5% return, 50% return. Do we have percentages? No, we don't. We are given the dollar amounts. We don't have any percentages yet. So how about we take the information that we are given and first figure out what they tell us about the percentage return we would be earning on this investment every single year. In year 1, in year 2, in year 3, and in year 4. So when you pay $100 to buy 1 share today, and when a year later the price drops to $50, what does it tell you about the annual return, the return over 1 year? Clearly, it fell by half, right? And the way we calculate return, which is clearly a 50% drop, right? We always use this little formula, and I always tell my students to memorize this trick as new minus old divided by old. New minus old divided by old. You take the new price, $50 at the end of the year, subtract the old price, $100 at the beginning of the year, and then you divide that the result that you find by the old number, $100. So 50 minus 100 is negative 50. We take negative 50 divided by 100 and get negative 0.5. That's in decimals. It's the same thing as a negative 50% return if you convert it into percent. So a 50% decrease in your investment value. Now we can use the same little formula, new minus old divided by old, to calculate the percentage return in the remaining 3 years. So what's the percentage return when you go from $50 to $100? The money doubles, right? What does it mean that the money doubles? It's a 100% return because you add another 100% of what you had, another $50 on top of $50. But to use this little trick, you do 100 minus 50 divided by 50, right? New minus old divided by old, and you get 1. That's in decimals. In percent, that's a 100% increase. Next, you go from year 2 to year 3, right? From $100 a share to $200 a share, right? What does it tell you about the percent return? Is it 200%? Actually, it's also a 100% return, just like what we just found for the previous year. It looks strange, but if you think about it, percentage return could be the same every single year, but it doesn't mean the same dollar amount that you gain. It could be different. So what's going on here when we go from 100 to 200? Once again, we double our money. And doubling our money means always the same thing. It's a 100% gain. You gain another amount on top of what you already had. Another 100 on top of 100. To verify it, to check the math, you do new minus old divided by old, and you get a 100% increase. Right, so the money doubles going from year 1 to year 2, from $50 to $100, and it doubles again when you go from $100 to $200. That's why the percent is the same for both years, even though they mean different dollar amounts. Here we gain $50, going from year 2 to year 3, we gain instead $100. Okay, and let's calculate the last return over the fourth year. New minus old divided by old. 150 minus 200 divided by 200. Negative 0.25. That's a 25% decrease. Negative 25% return. Okay, so why did we have to go through this? Because we need to calculate the average annual return. And return is typically measured in percent, right? So now we have the percentages. Minus 50% in year 1, 100% in year 2, another 100% in year 3, and minus 25% in year 4. Okay, that's our starting point. Now, what's the average? Well, super simple. The arithmetic average is nothing but the simple average. You add up the 5 returns that we have, divide them by the four returns that we have, divide that sum by 4, and you get 31.25% on average every year, right? You can either add the returns in decimals, then you get the answer in decimals. You could also do the sum using percent and divide by 4, in which case you would get 31.25% directly. What does the arithmetic average annual return tell us? It tells us that if you invest your money for just 1 year, whether you buy the share today and sell it a year later, or you buy it in 2 years and sell 3 years from today, the point is you buy and sell it 1 year later. If you do that, your annual return would be 31.25% on average, right? And now let's look at the geometric average return, the last question. So we have our prices, they were given. We have just calculated the returns in percent, in decimals, which we use to find the arithmetic average. Let's look at this information a little bit differently. In year one, the stock price was $50, right? How did we get 50? Using the return that we calculated. It's like saying that you paid $100 today in year zero, then you multiplied by 1 plus the return over the first year, which is negative 0.5 or a 50% decrease. And that formula is, this formula is how you go from $100 to $50 in year one. Now, year two, stock price drops to 100, which is given, right? It's as if you are saying that you started with $100 in year zero, and then you multiplied by 1 plus the return in the first year times 1 plus the return in the second year. So it's like doing the future value calculations. Remember FRL 300, chapter 5. Future value is the initial amount multiplied by 1 plus the interest rate R. It's exactly what's going on here. Why is it not 1 plus R? Why do we have two multiplication terms? That's only because the return is not the same every year. It's a 50% decrease in year one and a 100% increase in year two. So we write them down sort of separately. Now, year three, stock price is 200, which is given. We can go to $200 by taking the original 100 in year zero, and once again, just like what we did for years 1 and 2, we can apply the future value sort of principle and multiply the initial $100 amount by 1 plus the interest rate over the 3 years. But we do them again one by one because they are different numbers. Same for the final fourth year. $150 given for the end of year 4 of our investment could be reached by taking the initial amount, $100 today, and multiplying by 1 plus the return in year 1, negative 50%, times 1 plus the return in year 2, 100% increase, or 1 in decimals. Same again in year 3, and a 25% decrease in year 4. So times 1 minus 0.25, right? Okay, what is the geometric average return? It's as if we are looking at these 4 different returns over the 4 years, right? And it's as if we are forcing them to be the same. If we force these 4 numbers to be identical, what would that number be? The same for each year. That would result in $150 investment value at the end of year 4. That's the geometric average return. So if the return is forced to be the same every year, then we don't need to have those 4 multiplication terms. We can have it only once and add the power 4, right? Okay, let's calculate it. This is what we have. Then we can get rid of the power 4 by dropping it on the left hand side, and on the right hand side we add the power 1 divided by 4 to everything on the right hand side. Then we want to get rid of 1. We drop it here on the left hand side and instead move it to the right with the opposite sign, minus 1. The rest, plug and check, calculate the answer to this complicated term. And if you do it right, maybe it will take you a little bit of time, you should get 10.67%. This is the geometric average return. So it's like the average of the four returns. But it's a slightly different interpretation from the simple average or the arithmetic average. 10.67% here means if you invest your money for 4 years, we are no longer saying for 1 year, for 4 years, the entire investment period. Your annual return would be 10.67% on average per year, right? Annual return, compounded annually. I completely agree that this is all very, very confusing. Let me explain it a little bit differently. Let's go back to what we were given. We were given $100 per share in year 0, right? It's as if we are saying that after the first year, our money grows by 10.67%. If we use that for our return, then we will have $110.70 approximately. Then our money grows by another 10.67% over the second year, right? As if. In which case, at the end of year 2, it's as if we have 122.5. Same in year 3, same in year 4. Guess what we get as a result? $150. This is what we were given, right? Except if you go back a few slides, we had this very jumpy, bumpy road to go from the initial $100 a share to the final $150 per share, right? We basically smooth it out. We remove all these ups and downs, bumps, right? And we are forcing the return to be such that we have this gradual increase in our money, smoothly going from 100 to 150, right? And because this return repeats every year, as if it repeats every year, part of our definition of the geometric average is compounded annually. And we have to specify the entire investment period, all 4 years in this particular example. By the way, there's another way to do this math, and you might really like it. Let's bring up the financial calculator. You can actually do it in the financial calculator. Let's turn it on. So essentially we are saying that we are starting with 100 and 4 years later we have 150. So it's as if $100 is our present value, right? Typically we are taught to set it to a negative value. So after pressing 100, I then press the plus/minus key to set the value to negative. And then I press the present value button, PV. 150 is what I will have in the future. That's like my future value. I press 150 and then the future value button, FV. How many years apart are they? 4 years. That's my N, number of years. I press 4N. And guess what I need to calculate in the calculator in order to find my geometric average annual return? That's right. All I need to do now is compute the interest rate. I press compute IY, and that's my answer. 10.67% per year, right? That's what it all basically means, and that's how it all kind of comes together. There's another way. So the good thing is, yeah, you can use this trick in the financial calculator, but the bad thing is usually you're not given the dollar amounts which you can use for PV, FV, and then compute the IY. Usually you are actually given you're given the returns. So usually a numerical problem on this topic starts by giving you the returns in percent, like minus 50%, 100%, 100%, minus 25%. And then what do? What are your dollar amounts? So there is another trick how you could do it in the financial calculator. Let's clear everything and start all over again. Let's say you have $1 today. That's your starting point. That's your present value. 1, set it to negative, PV. 1 year later, your return is negative 50%, right? So 1 is your N. 50% negative is your return, IY. How much will you have from your initial $1 at the end of the first year? Compute future value, 0.50. Kind of matches what we have, right? So that's at the end of year 1, right? So now I'm showing you in general how you could, use the financial calculator to find the geometric average. So step 1, PV equals 1, like $1. Take the return that is given for year 1, use it as your IY, and compute the future value after 1 year. You got 0.5. Now, this is the PV for the second year. Change it to negative, hit PV, 1 year later, so 1N, with the return of 100%, so 100 IY, what will the future value be? Compute FV. We have $1, right? And that's what we had. We are going back to where we started at the end of year 2. Now repeat that 2 more times using the returns of 100 and minus 25% for the remaining 2 years. So I wanna set this now to be my PV for the third time. So plus minus PV, 1 year later, 1N, 100%, another 100% return, so 100 IY. What's my future value? Compute FV. And last time, this becomes my PV. I can change the sign to negative and hit PV button to save it. So plus minus PV, 1 year later, 1N, minus 25% return. I press 25, then plus minus, and then IY, and I'm computing future value, 1.5. So at the very beginning we had 1, now we have 1.5. So you can write these two numbers down. The first one would be always 1, and then write down 1.5 that you found after year, 1 year at a time, entering the returns that are given to you in your problem. So we have 1 and 1.5. Now we can start all over again. So 1 plus minus PV, 1.5 is my FV. We have 4 years. We had 4 returns that were given, so that's our N, 4N, and we are computing the implied return that makes the smooth transition from 1 to 1.5 over the 4 years. So I'm computing IY. Same result, 10.67, right? So this is a good trick when you're given returns already. There are no dollar amounts at all. So you use each return one by one to find the future value 1 year at a time, and you can start with the initial amount of $1. Write down what you have after 4 years, the future value at the end of year 4, and then 1 is your PV. What you have for the future value in year 4 is your FV. How many returns you used is your N, and you compute IY. That's your geometric average. Okay, so where were we? We were right here. So I showed you basically 3 different ways to find the geometric average. 1, we actually used this formula. 2, if you know the dollar amounts, which is where we started this entire problem, then $100 is your PV, $150 is your future value, 4 years in between, that's your N, and you're computing IY in the financial calculator. And the third method I've just shown you was if you don't know any dollars, you just know the the 4 returns, right? You can use them one by one to find future value 1 year at a time, and then the last future value is your FV, 1 is your PV, they are 4 years apart, 4 is your N, compute IY, same result. Okay, so to summarize, in this particular problem, the arithmetic average was 31.25%. The geometric average was 10.67%. Completely different results, and their interpretation is a little bit different. Let's do a couple examples. Before that, you might be wondering, okay, how do we know which one to calculate? Well, that's always given. Okay, but in real life, which one is more appropriate? Should we always calculate both? How do we know which one is better? Typically, the arithmetic average is more appropriate for very short-term investments. Like you only want to invest your money for a couple of years. And then it's good enough to just find a simple average, which is what the arithmetic average is. The geometric average is more appropriate when you plan to invest your money for several years or many years, so for long-term investments. The rule of thumb that the book recommends, arithmetic is good enough to use if you invest for under 20 years, because in real life the arithmetic and the geometric results would be so close that it's not worth it calculating the geometric one. The geometric one is definitely the one to use if the investment period is longer than 40 years, because it's a very different number from the arithmetic average. And the book says that split the difference if your investment period is somewhere between 20 and 40. In this class, on the exams, in the homework assignments, you probably will never see more than 6 returns that are given to you. So a 6-year investment project. Okay, couple of quick examples. By the way, this is the general formula for the geometric average. Only use it if if you think it's easier than doing it in the financial calculator. And remember, I showed 2 ways to do it in the financial calculator. First example, arithmetic average, geometric average. These are the 3 annual returns in percent. Arithmetic average, add them up, divide by 3. Very simple. 4.67%. Geometric average, you use the formula. We have 3 years, 3 returns, 1 plus the return, separately for each year. The 3 terms are multiplied by each other, and then the whole thing is taken to the power 1/3, and then we subtract 1. If you do it this way, or if you do the financial calculator trick, then you would get 4.49%. The 2 averages are a little bit different, and they should be interpreted differently. Once again, if you invest the money for 1 year, you should expect the return of 4.67% on average. That's the arithmetic average. If you invest your money for 3 years, then you should expect your money to grow every single year by 4.49% on average, every single year, compounded annually. That's the geometric average interpretation. You invest for 3 years, not for 1 year. Second example. What if we have, again, 3 returns for 3 years and they're all the same? Well, what's their average? What's their simple average or the arithmetic average? Well, you could do 6 plus 6 plus 6 divided by 3, or you can realize that, well, it's 6, right? It's just 6. What about the geometric one? Turns out, in this special case, when all returns are the same, it's also going to be 6%. Every year your money grows by the same percentage, and that's exactly what the geometric average means. Okay, I hope this topic is clear, and it's important for the exam coming up, and just in general. Now you have, kind of a better understanding of what we mean by average, and in real world, when you make an investment for 1 year or for several years, in which case, which one of the two averages is more appropriate to look at. In this part of chapter 12, I would like to explain the topic of risk when applied to stock investment. On this figure, we have several lines going up. So imagine your great 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 grandfather or some distant relative invested $1 in 1925. And let's say that relative of yours had three more friends. So the four of them each invested $1. One bought however many shares of stock he could with $1 of a small company, different small companies. That's the green line. And so when $1 was invested in 1925, it was more or less increasing in value over time as prices of shares of stock of small companies in that portfolio that was purchased were going up over time. The second person also invested $1, but instead into shares of stock of large companies. That's the orange line, a little bit below the green one. And then the other two invested in bonds. One bought government bonds that make payments over a long term, the blue line, and the other one, the brown line, the one that's below the other three, is treasury bills. Also government bonds, but short-term government bonds that pay the money back over several months. And let's ignore the purple inflation line. So just focus on the first four, the top four: green, orange, light blue, and brown. So we are comparing these four historical investments, how the money has been changing when invested into each of these investments individually since 1925 until roughly 2013. 2013 is the last year. So this 88-year time period. And in the earlier slides, on the earlier slides in this chapter, we saw how the fact that the small company stock line, the green line, is the steepest, it implies the highest return that was earned on average every year. The second highest average annual return was for the orange line, the large company stocks, and so on. Now we want to focus on risk. Which of these four investments that we are considering has been by far the riskiest? The best way to look at it is to look at the jumps. What do the jumps mean? Sometimes you make a lot of money, then you lose a lot, right? Which one of these four lines is the jumpiest? Which one has the most up and down changes along this trend? It's kind of obvious that the green line is the winner, or maybe I should say the loser, right? Because when we talk about risk, we mean something bad, right? So it has been experiencing the most fluctuations or volatility or variability. So volatility, variability, risk, uncertainty about what you get every year, it all means the same thing. So the green line, small company stocks investment, has been by far the riskiest. The second riskiest has been the large company stocks. So stocks in general are the riskiest investment, or at least have proved to be the riskiest historically. And bonds, government bonds, are safer, lower risk, more certainty about how your money will be growing. In other words, what return you will be receiving every year. So not as jumpy, not as volatile. From the bonds, the government bonds, the shortest term, the treasury bills, the brown line, is the safest one. So this is what we are seeing when we just look at the historical data, at the returns that are already known to us for these different investments. And this is how these different investments compare to each other. So how would we calculate risk? How would we measure the amount of risk in different stock investments? Let's forget about stocks and imagine we are, somewhere fun like Las Vegas. Imagine there are two slot machines. You can play slot machine number 1 or you can play slot machine number 2. We are going to answer the question, which of the two machines is better? Let's say if you play machine number 1, these are the 4 possible outcomes, and they're equally likely. They're kind of randomly repeated, right? Over and over and over and over as you play the machine. You can win $100,000 or $75,010 or $25,010, or you can lose $200,000. If you instead play machine number 2, you can either win $100 or win $30 or lose $5 or lose $105. So these are the 4 possible outcomes for the two machines, and they are randomly repeating, so we can say they are equally likely, right? So let's say, you've been playing these two machines, first one, then the other. Which one has shown the more risk? Which one has been riskier? Which one has been safer? First, if you do the right math, you would realize that it doesn't matter which machine you play if your only goal is making money. You actually end up with the same amount of money on average. How do we know that? Well, add the 4 possible numbers up and divide them by 4. That's your average gain per game as you play it over and over and over. $5 if you play slot machine number 1. If you do the same math, slot machine number 2, so you add up 100, 30, -5, -105, and divide that sum by 4, you get also $5. So it looks like it doesn't matter which machine you play if your own comparison is how much you make on average per game. But what about the risk? Are the two machines similar in how risky they are, how much risk they offer, how much uncertainty they offer to you? Well, you don't need to do the math to realize that machine number 1 is riskier because the numbers are so much apart, so far apart. You can win up to 100K, but you can lose 200K in one shot. Whereas slot machine number 2 is better because the 4 numbers are not that far apart. Apart from what? From the average. And that's how we measure the amount of risk. We want to calculate something that tells us how far on average from the average we would be if we play each machine. This is exactly what the concept of the standard deviation does. So usually we calculate the variance first and then the standard deviation, but both tell us exactly the same information about the amount of risk. So in other words, we want to calculate how far on average our 4 winnings separately for each slot machine are away from the $5 average that we have just calculated. Let's look at machine number 1. We calculate the distance from $5 for each of the possible outcome. So 100,000 minus 5. And we want to add up those distances from the $5 average and, find their average. The average distance from the $5 average. But if we don't add the power 2, we're gonna get 0, because everything will cancel out. When we win, we may be above the $5 average. When we lose, we will be below. And that's why the sum of all distances will always cancel out perfectly, and we would get 0. In order to not get 0, we can use this trick by adding the second power, squaring the distances from the average. And that eliminates the whole, plus sign being canceled out by the minus sign for some of the terms. Another little detail that's important when we look at historical variance calculation, we don't divide by 4, but we divide by 4 minus 1. This is something they call the degree of freedom in statistics. So the stat field is sort of where you would learn kind of the depth of this way of calculating the variance more accurately. So not by 4, but by 4 minus 1, which is 3, in other words. So we get this large number, that's the variance, and then we take the square root of that, which is in a way removing that second power that we added, just so nothing gets canceled out. So the square root of variance is the standard deviation, and we get $136,933. This means that if we keep playing the slot machine number 1, we would be on average earning $5 per game, but the actual amounts of money we would be making or losing would be $136,933, either above or below the $5 average. So that's the average distance from the average. We can now do the same calculation for slot machine number 2. Squared deviations from the mean added up divided by 3. So not by 4, but 4 minus 1, which is 3. That's the variance. The square root of that is the standard deviation, $85, which means we are winning on average $5, but the actual amounts we would be seeing are on average $85 above or below $5. So again, it's the average distance in either direction from the mean. This is how the standard deviation actually calculates the amount of risk. And so now we can compare the two machines sort of in the scientific way. We calculated the standard deviations. Which one is higher? Slot machine number 1. That's the riskier machine. This is how we compare risk. And it's definitely more relevant when we are not sure by simply looking at the numbers which one implies a higher distance from the average. In this example, it's pretty obvious, but when it's not, you have to calculate the standard deviation, which will tell you exactly where you see a higher amount of risk. Okay, now we apply exactly the same formula to what we are learning in this chapter: stocks and bonds, actually, financial securities. So variance and standard deviation, that's how we actually measure or calculate the amount of volatility, or how much change we see in the returns of our assets, stocks and bonds. And the higher the jumps, the higher the uncertainty regarding what you will get every year, and that would result in a higher variance and standard deviation. So more jumps, higher amount of risk. Okay, so historical variance, we calculate the squared deviation from the average, then we add all of them up and divide by how many we have added up, minus 1, which is this general formula: variance, or VAR, of returns. Sigma squared is a common symbol for it, and again, R's are the returns. So R1 means return in year 1. In our particular example, that's the return going from year 1925 to year 1926. R2 is going from 1926 investment value to 1927 investment value. We calculate the return in percent. That's R2. RT, in our case, that's for going from 2012 to 2013, our last 88th year in our historical time period. And R bar everywhere is the same number. That's the average return, just the simple average for that entire 88-year time period. Once you find the variance, you then take the square root of that, and that gives the standard deviation, which tells you how many percent above or below the historical average return you were on average in each year. Applying that formula to, let's say, large company stocks. So that's our on our diagram, that's the second, the orange line, large company stocks, right? The second from the top. So we use the information on the returns, which are in the textbook for each year. So 13.75% return in the first year, going from 1925 to 1926, and so on. So this covers 88 of those returns, 88 years. And then for each we subtract the historical average, which was calculated on one of the earlier slides, square, add them up, divide by, not by 88, but 88 minus 1. That's the variance. And then the square root of that is 20.2%. So 20.2% on average is the distance from the actual return from 12.1% return. When we do this math for each of our 4 investments, so small company, large company stocks, long-term, short-term government bonds, then once we do the math, we would get the following results. And the highest risk is where we see the highest standard deviation, 32.3%, small company stocks. That was the line that lies above all other lines. That was the green one in our figure. And then the line that was the flattest, kind of at the very bottom, the US Treasury bills, sure enough, has the least amount of risk, which is seen in the smallest standard deviation, only 3.1%. Okay, so that's the amount of risk for our 4 different financial investments of interest based on 1925-2013 time period. Now let's apply this calculation to a different example, and I will walk you through the steps you need to follow. Some calculators allow you to input the numbers and then they calculate the standard deviation, the variance, everything for you. But be careful, there are several versions of the variance, how it could be calculated, and we are learning a specific way of doing that. So let me walk you through the steps that follow our formula, our particular formula. Let's say we are given 4 returns for 4 consecutive years. We want to see how much risk is implied. So 15% return during year 1, 9% return in year 2, 6% return in year 3, 12% return in year 4. What we do first step, we calculate their average. Simple average, which we also call the arithmetic average. We add them up, divide by 4, and get 10.5. Then we can, to help us with the remaining calculations, we can then copy and paste this result next to each return in our table, 10.5%. Then step 3, deviation from the average return, which means the distance. So actual minus average. 15 minus 10.5, 4.5 for the first year. Negative 1.5 for the second year. Negative 4.5 for the third year. 1.5. Negative 1.5 for the second year. Negative 4.5 for the third year. And 1.5 for the fourth year. That's the 4 deviations. How far the actual returns are away from the average. Then the next step 4, is we square them. So we take these 4 numbers and we add the second power. That gets rid of any negative signs we had for some of them. Everything is now positive. These 4 positive numbers. What's the next thing we do? We add them up, and when we take the sum of the squared deviations from the average and divide by not 4 but 4 minus 1 or 3, we get what we call variance. And then the last step is square root of that. That's the standard deviation. The square root of 0.0015 is 0.03873, or 3.873%, which means when you invested into such investment that produced these actual 4 returns for the 4 years, that tells us that on average the return was 10.5% per year, but the actual returns were on average 3.873%, either above or below this average, 10.5% average, either above or below. So in either direction, this much away from the average. So these are essentially the steps we are following to find the standard deviation, which is the measure of risk. And then the next few slides kind of take us one step further. Now that we hopefully understand what we mean by risk and how we calculate it, then we can say even more about the riskiness, the amounts of risk for our different investments. In this table we have large company stocks, small company stocks. We also have treasury bills and long-term government bonds, the 4 that we were looking at a second ago. But the table has even a few more. Average return for each, standard deviation or the amount of risk for each. You might recognize some of these numbers that came up a few minutes ago. And in the last column we have what is called frequency distribution for each investment. What do the frequency distributions show? Let's pick an example. For example, large company stocks, right? In our table, that's number 1, the first row. Large company stocks. We are essentially saying something like this. Let's say earning a return between 0% and 10% over 1 year. How many times did that occur? What's the frequency of earning that high return? Well, it occurred in 1947, in 1948, in 1956, in 1960, and so on. So we can count how many times it occurred, what the frequency was. And different returns occurred in different years. Some returns were kind of more popular, like the tallest column is for the return between 20% and 30%. That's in 1 year. That's where we have the most years, right, in which it occurred. And so we kind of basically, increase the height of the columns for the return which was more common. And clearly something unusual like losing more than 40% of your money in 1 year. That only occurred once in 1931. That's actually part of the financial, like the Great Depression financial crisis in 1930s. Then other unusual returns, for example, very good returns, earning between 50% and 60% in 1 year. That occurred only 2 times. Okay, so that's what the frequency distribution tells us. That's how it's built. Now let's kind of simplify it. First, what does it look like? It looks like what we call the bell curve, right? Kind of smoothly goes up and then goes down. That's what the normal distribution looks like. So normally there's this peak somewhere in the middle, and then what's below the peak and what's above the peak is less common, has a lower occurrence or lower frequency, and it's symmetric on both sides. That's the normal distribution. Okay, so this is an example still on large company stocks. Let's answer a few questions. Question number 1. In the middle, right where we see this, the peak, we have a 0 and then we have 12.1%. What is 12.1%? If you go back a couple of slides, that was nothing but the average return. Average over that time period between 1925 and 2013. Now, next to it, to the right, 32.3%. Above it, it says plus 1 sigma. Sigma is the notation we use for the standard deviation. So it means if you take the average and add 1 standard deviation, you get 32.3%. Does the math add up? Well, let's go back a couple of slides. 12.1 average plus the standard deviation, 20.2, gives us what? 32.3, right? 32.3. We can instead subtract 1 standard deviation, which would give us negative 8.1%. We can also add or subtract 2 or even 3 standard deviations, and we can even go beyond that. And we would kind of calculate the resulting percent return for those. So that's the answer to question number 1. Question number 2. There are 3 extra numbers under this bell curve: 68%, 95%, 99%. What does, for example, 95% show? It tells us that 95% of the time the return has been between within 2 standard deviations, so between negative 28.3% and up to 52.5%, right? So when we're talking about our 88-year time period, 95% of the time, which is what, I don't know, maybe 86 out of 88 years, something like that, the return fell in this range, and only in a couple of years it was beyond that range, so much lower than negative 28.3% in 1 year, or higher than 52.5% return in 1 year, right? And 68%, for example, shows that 68% of the time, so 2/3 roughly out of our 88 years, the return was within 1 standard deviation. So in this range, between losing 8.1% of the money in 1 year and gaining 32.3% of your money in 1 year, in this range, sort of the greenish, grayish shaded area. Question number 3. We have this pink shaded area on the left and on the right under the curve, kind of where the tails are, right? 2 tails of this distribution. What do those 2 pink shaded areas mean? Well, what do we have for the cutoffs? Minus 2 sigma and plus 2 sigma, right? It means then we also have 95%, right? So 95% of the time we are within this range, and 5% of the time, the remaining 5% of the time, we are outside this range. So 5% of the time the return was below minus 28.3% or above 52.5%. Either below or above these two percentages. 5% of the time. That's question number 3. We can also add and say something like, so what does 99% mean? It means 99% of the time the return is within 3 standard deviations. So minus 3 sigma to plus 3 sigma. And the remaining 1% of the time, so 1 in 100 years, right? The return is super high, above 72.7% in 1 year, or super low, losing more than 48.5% of your money in 1 year. And now question number 4. In how many years during 1925 to 2013 was the annual return above 52.5%? So this is 52.5%, right? It corresponds to 95% probability or chance of occurring, right? Or actual occurs, since we're talking about the history, about the past. So annual return above 52.5%. That's this pink shaded area on the right. And so 95% is within 2 sigmas, and what's beyond 2 sigmas on both left and right is the remaining 5%. And because the bell curve is symmetric, each of the pink shaded areas must be the same area. So if you take the 5% that remains and divide by 2, we get 2.5%. So to answer question 4, 2.5% of the time over this 88-year time period, the return was above 52.5%. So what's 2.5% of 88 years? That's, I don't know, 1 or 2 years approximately, right? So that's how often it occurred. And actually, maybe we can go back here. Well, that's where we see, in which years we had it. So these 2 years are our good candidates. Maybe only in one of those the return was above 52.5, and one was just barely didn't make the cut. But we can see the answer right here. Okay, so this is the end of the topic of risk in the financial markets. In the next few minutes, I would like to explain the topic that is known as capital market efficiency. It has to do with why stock prices, or maybe not stock but bonds or other financial securities, but let's stick to stocks. Why do stock prices change so much all the time? You might know that stocks for Apple, Facebook, Google, and thousands of other companies are fluctuating on a daily basis. Why is that? That's what this topic is about. On this figure, I have Google stock for year 2008 and 2009, about 12-month period. And it shows that the price is going up and down, up and down, up and down, right? Some big fluctuations and small ones along the way. And there are a lot of things which are highlighted for, especially for the times when there were big drops or big jumps, like Bing launch is marked here. Google to buy some company is marked here towards the end. Yahoo Bing deal. Google lays off sales and marketing people. Somebody says that the economy is pretty dire. Things like that. So it could be some announcement made by some economist or some big maybe um, merged by some competitors in the same um, area of business, or somebody said something about Google, or Google did something, right? So it's all the different things that happen that affect Google and how much people are willing to pay for Google stock shares that are actually the reason why stock share price fluctuates so much and so often. So it all has to do with the information that comes in that somehow makes people more hesitant to buy the shares, and so the price drops, or more willing to buy the shares, and so the price jumps. So it has to do with the prices adjusting to the new information that arrives. We say that the stock market is efficient if, when something new happens that affects the stock price adjusts quickly and correctly when that new information arrives. That's the capital market efficiency. And the so-called efficient market hypothesis says that the capital market, such as the New York Stock Exchange, is efficient. Um, some researchers out there believe in it, others do not believe. Those who do not say that when something new comes in, people sometimes overreact or don't fully understand the implication of that big news, big announcement, and so the prices do not reflect that accurately. Okay, on this chart we show the reaction of stock price to new information in efficient and inefficient markets. So 0 means the day when some announcement is made by some imaginary company. -2 means 2 days before that announcement will be made. Nobody knows about that announcement. People don't know about it yet. -4 means 4 days before. +2 means 2 days later, after the announcement has been made in the news, like became public information. And on the vertical axis, we have price per share in dollars. So up until the announcement is made, the price per share is $140 flat. Then this announcement is made. Does it look like the announcement is good or bad? Probably good, because the price goes up, right? People wanna pay money. They believe in the company doing better in the future following this important announcement. And if the company would be doing better in the future, the company managers would be able to increase the amount of dividend that they're paying to all stockholders. Okay, so we have kind of 3 ways how the price goes up following this announcement on the announcement day. We have a step, the solid blue line. If the step happens, the price immediately jumps to 180 per share. Then we have the light blue dotted line. The price kind of goes to about 220 and then goes back to 180. And the orange broken line, where the price slowly goes up to 180 over the next several days. Which one of these 3 adjustments to the new information is efficient, and which one or which ones are inefficient? This step, the solid blue line, is efficient for 2 reasons. The definition of efficiency is quick and correct adjustment. It's quick because the announcement changes the price right away that same day. It's correct because it stabilizes at the new level right away and stays there. It doesn't change anymore. That's why the solid blue line reflects efficient market reaction. What about the dotted blue line? It's inefficient because it overreacts. It does not adjust correctly. And remember, adjusting correctly is half of how we define efficiency in finance. So it does adjust right away, but people overreact. They interpret the news as something being way too good, they're paying way too high price, and then they realize it's not worth it, and then the price goes down and settles. The broken orange line is also inefficient. It means a slow adjustment. The price does start reacting immediately, but it takes a while until it settles at the correct new level. So only the solid blue line, which looks like a step, reflects efficiency. The other two are examples of how we could have an inefficient market. What about something like this? So it's not in the book, I added it myself, the red line. So it shows how the price, actually let me fix it. It should be more like this, okay? So it's at 140, then it starts going up a few days before the announcement is made, and then it settles at the new level. What does it mean? Is it efficient? Is it inefficient? What does it mean that the price starts going up before the announcement to the public is made? This is what we call insider trading. So somebody working in the company who knows what will be announced before the other billions of people on this planet, and they use this information to start trading that would make them benefit from the trade. So for example, they know already that the price will go up. How can they benefit financially? They can buy a lot of shares now, because just a few days later they can sell it for more money and become rich. And so if hypothetically, if there are a lot of insiders working at the company who know that information and who will start using it for their trades, that may affect the price. A high demand makes the price go up. But this is something that is considered illegal. You cannot trade stocks based on the information that is considered to be an inside information that is not known to everybody else around you. It's not legal to do that. You can go to jail. Okay, so now what makes markets efficient? Basically, what makes them efficient is the fact that there are advanced computers in our life these days. There are people on Wall Street who are paid $500,000 a year, $1 million a year to do, the only thing they do is, gather information on different companies, write sophisticated codes for programs that analyze, let's say, the content, the keywords in that information, and try to predict where the prices are going. So it's because there are a lot of investors out there doing research, gathering information on companies, trying to be the first to sort of beat the market, the first to find something new out and make the right next move, buy or sell a lot of shares of a specific company. And all this information these days is processed in seconds, right? Back in the days when there were no computers, no internet, it probably takes a while for some information to be delivered to people around the country, right? So back then, the markets were definitely inefficient. These days, they are, if not efficient, then very close to be what we call efficient. And so in theory, if let's say investors are stop researching stocks, let's say internet goes down, right? Phone lines go down for a month. Then if something like that happens, it will be taking a lot of time for the information to spread and be known to the public, which will make the stock market not efficient anymore. And then another thing that's part of this whole capital market efficiency topic in finance is three forms of market efficiency. Weak form is when you research prices on shares of stock of different companies. And let's say your analysis shows that all that the prices reflect, like the reason they went up or down, the only information they reflect is the past information. And that's what researchers kind of mostly agree on these days, that that's all the prices reflect. What would be a different amount of information that could be reflected? Semi-strong form efficiency. That's not only past but also all publicly available information, everything that's known about the company today. Any press releases, any annual reports, anything about trading going on today in the past days, everything out there is what people look at to determine how much they're willing to pay per share, and that's what determines the price per share. If that's the case, we say that the market is semi-strong form efficient. Now, if you also add, so if you have past information, today's publicly available information, and private information, meaning something about the future, right, that only some people know but not the rest of the public. If that's how the prices change, and that's kind of what I showed earlier with the red line, right? If private, group of people trade based on what they know about the future, right? If this is how stock prices are changing, if they imply that the information reflects that the prices reflect information that is not publicly available yet, such as private inside information, then that would be called as the strong form efficiency. Okay, but that's not what the empirical evidence suggests. So researchers show that this is definitely not what's happening. Maybe semi-strong form efficiency, but it looks like it's weak form efficiency. Okay, let me show you one example to complete this topic, to kind of, clarify what it all implies. Let's say you have a neighbor. He trades stocks all the time, and you know that he's constantly overhearing things at his workplace. He gets access to some confidential information, and that's what he uses to trade stocks. So he overhears something that will happen in the company. If it's something good that will make prices go up, he buys a lot of shares because he knows that the price per share will go up, and he will sell the shares then and make profit. Okay? So this information he's using for his trades is not available to the general public. This neighbor continuously brags to you about the profits he earns on these trades. This is the important sentence. He brags to you about all the profits he earns on these trades based on the inside information. So he makes profit based on the inside information. Given this, this implies that the financial markets are, at best, form efficient. What's the right answer? The right answer is D, semi-strong, because if the market was strong form efficient, it means what? It means even though he has access to private information, it's already too late. It's already reflected in the prices. He cannot make profits. But because he can make profit based on the inside information, it means the market is not strong form efficient. So either semi-strong form or weak form. At best, semi-strong form. That's the answer. Semi-strong form efficient. So the other options would be weak, strong. We talked about strong, semi-strong, weak. Semi-weak, this term does not exist in finance. Perfect, it does not exist when we talk about market efficiency. So only your choices should be only between strong, semi-strong, and weak. And in this particular case, D, semi-strong, is the right answer. Let's review chapter 12. First, we looked at Which of the historical investments discussed have had the highest average annual return? So the answer to this question is small cap stocks or small company stocks. That's the investment which has been growing the fastest, so it had the steepest sort of trend in the investment value over time, which reflects the highest average return every single year. Which of the historical investments discussed have had the highest risk? Same answer, small company stocks. And actually, the ranking of the investments by both average annual return and risk is the same. At the top, we have small company stocks. Then we have large company stocks. Then we have long-term government bonds, and then we have short-term government bonds. 3. What is the difference between the arithmetic average return and the geometric average return? Arithmetic average return is nothing but the simple average return. That's when you invest your money, for just 1 year, and you're looking at before and after, how much you invested at the beginning of the year and how much your money grew to by the end of the year, what the percentage change is. So if you invest your money over for just 1 year, then across all the different 1-year investments that can be made, on average, your money grows by some percentage. That's the arithmetic average return. Now, what is the geometric average return? Here, your investment period is not 1 year. It's longer than that. So let's say you're given a 4-year investment period. So imagine so in this case, you need to consider the entire investment period, all, let's say, 4 years. And you need to calculate what's implied about the return you're making every year that would be compounded annually. So the geometric average return is the average return over 1 year compounded annually, but it's for the entire investment period. So in a way, you're kind of forcing your money to grow smoothly at the same exact rate year after year after year over your investment period, rather than allowing for some years to give you a higher return and others giving you a lower return. You're kind of forcing all of them to be the same percentage return every year. That's the geometric average return. What does standard deviation show? The way I always explain this term is it's the average distance from the average. So you first calculate on average what return you are earning, and then you're focusing on the actual returns, which are kind of scattered around that average, and you're calculating on average how far those actual returns are from the average, going sort of through all of them in the middle. And that's the average distance from the average, whether it's above or below the average. So the standard deviation is always a positive number. It's never a negative number. What is meant by capital market efficiency? The capital market is, that's kind of trading stocks and bonds, is called efficient if 2 conditions are met. One, when new information about the company's stock or maybe bond arrives, that information gets incorporated into the new price of stock or bond very quickly. And the second condition that must be met for the market to be called efficient is that when this new adjustment in the price happens, it is done correctly. So there is no overshooting, so to speak, where the price would like overshoot and like jump too high up and then later adjust to a lower correct level. There is no such sort of mispricing, and everything gets priced correctly and quickly. So correct and quick adjustment to the new information that comes in. That's what makes capital market efficient. And the last bullet point is, what are the three forms of market efficiency? The three forms are weak form, semi-strong form, and strong form. Weak form efficiency means that the information that's reflected in stock prices only reflects historical information about the company. Semi-strong form means that the information incorporated in stock prices is past information and current publicly available information. And strong form market efficiency means past information plus currently available public information plus any information about the future, which is technically something that should not be happening. Otherwise, it's called illegal. Because strong form efficiency reflects the fact that prices on stocks today reflect any information that the public is not aware of, something about the company's future. So we are basically talking about some sort of insider information. And if that's already reflected in the stock price today, then that's, something is wrong. It should not be the case. A lot of research has been done about kind of trying to see how exactly stock prices are, changing and what kind of information makes those changes. And the research shows that stock market appears to be weak form efficient.